TheoTrade. This is Don Kaufman. June 11th, 2022, doing the TheoTrade weekend update on a Saturday morning. Our market's headed to uncharted territory. I'm going to give you some detail on precisely what that entails, but to kind of kick it off here, obviously some fairly wild sell side activity, both late Thursday, Friday, driven in large part by the CPI. Listen, there's going to be some terminology that you're going to hear just incessantly in this marketplace. Inflation, stagflation, recession, obviously rising rates, but I'm going to break down a little bit of what you can anticipate just in the next few days to few weeks of trade right here. But let's start to just give you kind of a brief week in review with, sellers returning with a vengeance to the marketplace. So this happens to be Friday's trading session. I'll zoom in for just a moment. This is again an hour before the cash market opened. The S&P futures dipped really hard on what was a rather strong CPI. I'm not sure strong CPI is the right terminology. That CPI came in hot, really hot, too hot to handle for the marketplace. By the way, that's a 1 minute candle. And the reason that I am starting with this is to give you a quick glance, quick feel, if you will, of what's both possible and plausible on an announcement like this in terms of volatility. And this is a move roughly from 40-20 in the S&Ps, extending all the way down to roughly 39, we'll call it just 70. It's a 50 handle move inside of the S&P futures in 1 minute. I love to explore aspects like that simply in respect to the fact that we get, used to, if you will, I guess a lull in the marketplace, lack of volatility, degrees of complacency. And we have been warning that that's precisely what you need, okay, to look away because I'm hideous. Markets, all right, are in a wild volatility channel over the last 2 weeks. That volatility channel snapped. We progressed lower. And the one thing that we had been mentioning for just day in and day out is don't, get off your game right now in this marketplace that we were very likely in, that kind of quintessential bear market rally, which is exactly what we saw. We came up just shy of the 42.11 in the S&Ps. We came screaming right back down into the gravity point of 39.31. And I have to tell you, I'm a little surprised some of the sell side that hit the marketplace in the last 15 minutes of the trading session, actually breaking us off that 39.31 gravity point. But I would say rest assured, you're going to see more of that 39.31 in trade early in the week. And that's one of the first things that I want to kind of denote is that we hit, it migrated directly to a gravity point. Now, before I go any further here, I want to open up a 3-year. Don't worry about what's down below. But one of the things that became rather apparent in both the Thursday sell-off, and by the way, that Thursday sell-side activity that kind of transpired in the last hour, that was because there were rumors that CPI leaked. We found out that those really weren't necessarily rumors, that somebody very much possibly did leak the CPI. I know the conspiracy theorists are out there; they're loving it. Anyway, so CPI kind of gets leaked, the markets tank, but not nearly as much as the markets tanked after the real CPI came out. Nevertheless, where are we right now? One of the things that I want to focus on is we don't have a lot of levels. We don't have a lot of levels, where we're presently trading. So it's pretty evident that we're butting up against some of the recent lows, big reactionary lows. And we're going to talk a bit about volatility here in just a moment. But the one point that I want to make with the S&Ps, and I know everybody, they're always looking for levels, and we're going to throw out all these different levels to them, One of the reasons I say that, markets are headed to uncharted territory. That uncharted territory is several different aspects. One of them is the S&Ps, because again, quite simply, we're out there. We're just out there right now. When I say out there, there's nothing to latch on to. Like, I don't want to talk about big, wild, reactionary lows that happen for a brief and fleeting moment. I mean, in effect, what you've had over here, and I'm actually going to pull up the spiders in this particular situation, what you've had is just this wicked gap lower. We're pretty much at the recent closing lows, and getting beneath this is I mean, this is where people go, well, where are we going to go? If the S&P is going to 3,500, and we could have a straight shot easily down to the, 3,200, even 3,000 level. Like, you cannot be surprised. And that's why I think we're headed to degrees of uncharted territory. And again, if you're listening to this and you're like, well, no, there's just no way, we're not going to fall that far that fast. Okay. I think you still have to kind of rationalize. There are some marquee players in this market that just haven't actually taken the hit that you think they have. I mean, we can go on and on about this, but if you start looking again on a 3-year time frame, we're not even back. We are not even back, right, to where we kind of kicked off, if you will, COVID. So if you have the assumption, and I think this is actually a fair assumption, I'm going to use Microsoft in this one. If you have the assumption that right in here, okay, this actually is pre-COVID, and right on that line, okay, is where COVID hits. The market absolutely tanks. The Fed steps in right in this neighborhood here, right towards the lows. The Fed steps in. Everything that transpires, okay, afterwards is, in very large part, if you count that as being a Fed-induced, marketplace to the upside, then you have serious cause for concern, because everything that's going on right now, and what you're about to hear from the Fed again this coming week, because we have an FOMC meeting, is contracting a lot of that liquidity, if you will, contracting a huge amount of capital from the marketplace. So if we are to head a little bit lower, again, I'm not saying that we're necessarily coming back to this peak right before COVID, but it's something that I think there's a very marquee level in almost every major underlying. And you start to look at stuff like Apple. Apple was trading 80, all right, ultimately before the COVID. And is the economy really that much better off than it was in a pre-COVID stance? And I think you have probably answer yourself, no, I get what you're saying over here. Right, so take a look around at a number of marquee underlyings. You can see stuff like Amazon. It's right there. Amazon's right there. If you take a look at stuff like Facebook's actually towards COVID lows. Take a look at stuff though like Google. You got some serious work to do. And I look a lot specifically at the financials, and the financials are not that far off, okay, of heading into what was that kind of COVID crash over here. But again, everything goes back to what the Fed ultimately did at that particular point in time to actually cause markets to get juiced to the upside. With that, as I said, sellers return with a vengeance, and we just don't have any great levels below this. And this is, again, I know everybody's going to come out and they're going to throw out MACDs and Fibonacci's and Bollinger Bands. Okay, there is nothing. There is nothing but, again, marquee underlyings that still have a tremendous amount of capacity, if you will, to the downside. And one thing that I'm continually measuring is, this is not getting like outright bearish, but I always think about upside potential versus downside risk. And it's much more important than directional bias to me. So I will reiterate a stance that I've taken day in, day out with all of the headwinds that you're in the marketplace right now. Okay, there is still this incredible downside capacity to markets. With at this point in time, yeah, we've had a couple rip your face off rallies, but they're extraordinarily limited. So limited upside, okay, potential, dramatic downside potential does not bode well for those that are presently bullish in the marketplace. So stop thinking about, are we going up or are we going down? And start thinking about risk reward. What's the upside potential versus the downside risks? If you want to get bullish, it's fine, but you then have to define your risk, or you're just going to get run over by this marketplace. All right, so sellers return with a vengeance, expected move in the 2 Sigma Beast. The 2 Sigma Beast, it's alive and well. One of the things that I really wanted to point out, and it's incredibly rare, okay, and I talk about an expected move just incessantly, and that is what the marketplace, the options marketplace, depicted risk to be, right? So if you were to look at this past week of trade, we are expecting just about $100 move, right? So it's a $100 move to the upside, $100 move to the downside. Now, what I wanted to point out over here, and I'm going to do it right here, right now, is take a look back at, well, just 2 weeks ago, we had a full-blown 2 sigma move to the upside. That is indicative of, again, what I kind of termed that quintessential bear market rally, which is exactly what we talked about just about a week ago. Then all of a sudden we have a 2 sigma move to the downside. What's a 2 sigma denote? It's 2 times the expected move. That's it. Like, don't overthink what a 2 sigma move is. If expected move is equivalent to $100, then a 200-point move, all right, is again a 2 sigma beast. And what is incredibly unusual, and this is why I wanted to pull this out, you're not going to see too many. Forget about 2 sigma moves. Yeah, you got one here. Yeah, this is pretty big here, but not exactly 2 sigmas. One of the crazy things, though, you almost never see them, okay, near back to back. Yes, this actually has a week separating them where we had a 2 sigma move, okay, a week of a lull, and all of a sudden snap back to the downside. But I'll give you a quick heads up. You can go back week in and week out. You will see some wild and woolly moves into, for instance, this is the actual COVID crash, where that's actually almost a 4 sigma move followed by a week off and another 2 sigma move, another one breaching. The point is, at right now, what you need to be concerned about is the marketplace is getting ripped apart. The options marketplace is clearly not getting the risk correct. And we have done ample studies on this and what it leads to, and why I'm talking about expected move and what I term the 2 sigma beast. It all comes down to inefficiency in the marketplace. So markets are incredibly efficient, and then they start to just rip apart at the seams. And what I'm basically saying is the market's not getting it right now. You know, this next week we're going to be expecting, and I'll show you a little bit later here, about $130 expected move. So with $130 expected move, right? Well, that's what the marketplace was anticipating. 130. We just moved 110 on Friday alone. Like, what are they thinking? Like, the volatility seems incredibly low versus some of the price action that we're seeing. Okay, you got to be concerned on the retail side. Can't sell anything in the short duration here, which again I talk about extensively. If you're going to sell anything, it has to be further out in time, has to be into a heavier skew. So again, it's a wild and woolly move, and it is indicative of markets not doing what they were intended to do. And here's the key to all the studies that we've done. When you start seeing like a 2 sigma move followed by a 2 sigma move, okay, you can actually get more breaches. So more breaches of expected move led to more breaches of expected move. Okay, efficiency, all right, leads to periods of more, okay, efficiency. Inefficiency, all right, can get very, very wild before ultimately calming down back into the expected move. But one of the most shocking aspects of this 2 sigma move to the downside is that volatility is not higher, okay, for the coming week. All right, so CPI was too hot to handle, but now I think one of the key points to be made over here is I'm talking about inflation and stagflation and recession and rising rates. To me, it's the bond market, okay? That this is, in large part, it's all been about interest rates. It's got to be about interest rates. We all know inflation is hot, too hot to handle. So you start looking at like the bond market. You're like, oh, so who cares, Don? Rates are rising. I get it. Rates are not just rising. If you take a look at the TNX, this is the 10-year. The 10-year, by the way, we talked about this on Wednesday night's video. Spot on! We talked about 3.1% and the big burst up to almost 3.2 that we were actually going to see a breakout of interest rates. Now, I'll remind each and every one of you, we traded for this, okay? We traded for a yield curve that was going to invert the 2 versus the 10. And this is kind of really integral stuff that kind of confuses a lot of people. But I'm gonna go for it right now and talk a little bit about the 2 versus the 10 because it's such an important concept that's often missed. So if we look towards the top of the screen, okay, this is the different durations: 1 month and 2 month and 6 month and 1 year and 2 year. So what I want to highlight is this 2-year paper, okay, versus 10-year paper. Let's actually start with that. And what you are looking at is data just for June. So if you take a look to the beginning of June, this is obviously June 1st, you will see that the 2-year was sitting at roughly 2.66. Okay, the 10-year is sitting at 2.94. You're like, well, interest rates went up. No. What you're missing over here, interest rates didn't just go up. Look at the 2-year. The 2-year absolutely exploded. We're at 3.06. okay, versus the 10-year, which is 3.15, which you're starting to see right here, right now. Get ready for it, folks, because you're seeing an inversion of the yield curve. You realize that the 5-year already inverted over the 10. Why do I bring this up? Okay, because that's the sign, people. It's a sign of a recession. And that's exactly why I did bring it up. It is the absolute sign of a recession. So you actually have inflation that's raising, just raging out there in inflation, okay, which leads to an inversion of the yield curve, which is likely to give us a hard landing in a recession, which ultimately means stagflation, rising rates. I mean, these are terms you're going to have to get familiar with, inversion of the yield curve, okay? The other aspect that really resonates with me from this marketplace, though, there was a lack of intensity, still a lack of intensity to the overall sell side activity. Big selling with a lack of volatility intensity. The VIX didn't move all that much. The volatility futures, let's bring them into scope. There's some really bothersome things going on the screen. So the volatility futures, if you don't speak geek over here, we're just going to look at the last price, and I want to highlight right here. So that's the July versus, for example, the August. Now, bear with me here because it's important to understand the July volatility futures didn't even eclipse the August volatility futures. So, in effect, we're not in a backwardation. We're actually still contango, not by that much. It's about a 30 to 35 cent contango that we're presently in. So the reason I say volatility futures inverting, like, it's pretty big sell side activity on both Thursday and Friday. I mean, Thursday you're down 90 handles. Friday we just cap it off with a nice 110 handles. You're down 200 S&P points in less than 24 hours, and boom, what does the market do? Absolutely nothing in terms of volatility. In fact, even cruise down to the VVIX, the volatility index. I think it moved. It's not moving enough. This concerns me. It concerns me on a lot of fronts. And it concerns me also when skew is also sitting down towards the bottom of the barrel. Nobody is panicking at this point. And it's one of the reasons I'm saying we are headed to uncharted territory, and we're headed to uncharted territory because have you seen, in any recent years, a lack of volatility like this with some pretty intense selling? Because I'm going to tell you right now, I surely have not. This is, again, this is not a commonplace factor. We are also right now, we're approaching a primary expiration, which is just going to compound the situation. If you take a look at the SPX, we're going to hit the official June expiration, which is both an AM settlement and a PM settlement. There are trillions of dollars coming off in open interest on Friday morning, trillions of dollars. And I don't often say anything about volume and open interest, but if you take a look at volume and open interest, look at some of the volume that's out there, okay? Look at all the contract size that is traded in these June options. It is absolutely insane. There are trillions of dollars coming off the books in the SPX, the spiders. It's going to be crazy, crazy in terms of gamma risk throughout the course of the week. So again, why is there a lack of volatility over here? The market simply not feeling the fear. And that concerns me because, again, we anticipated some sell side activity to transpire. And when it did transpire, that everybody was going to reach for puts, they were going to freak out, and the market was going to get slammed lower. The market did get slammed lower, but nobody really freaked out. All right, the dollar absolutely exploded, just exploded. Okay, both Thursday and Friday to the upside. But one of the crazy things about the dollar exploding, okay, towards the later portion of the trading session, specifically on Friday, you also had metals take off to the upside. So I've actually got bullish positions specific to SLV. We're pleasantly surprised that even in a strong dollar, I would look, and again, the reason I'm covering this is not just because I have positions in SLV. I would look for continuation for metals to the upside. All right, metals actually have a decent bid in what has been a strong dollar. That is just glorious for a bullish setup right now inside of those metals. Again, S&Ps, what do I anticipate? A lot of bouncing around back to the 39.31, okay? Pretty evident, and that 39.31 is only a hop, skip, and a jump higher. But ultimately, we also have an FOMC announcement coming throughout the course of the week, okay? This week is fairly pivotal. So you have a major options expiration. It's everybody calls the triple witching. Triple witching is coming. We are actually headed, okay, and a lot of people are not aware of this, but we are headed officially into a 3-day weekend, okay? June 19th, the equity markets, equity bonds, everything will be closed on June 20th. So we're going to be heading towards a 3-day weekend with a huge options expiration on Friday. Again, it's a triple witching out here. So there's going to be a lot of movement. It's impossible to be able to read through what's going on in the S&P volume because there's 2 million contracts here, 2 million contracts here. People, we're going to be trading like a mess. All you want to try to do is grip hold to specific levels. All I have to the upside here is 39.31 that's in scope. I don't think we're more than a hop, skip, and a jump away from 42.11 over here. That's all I ultimately have, though, to the upside. We start getting above 39.31 and maybe another little bit of a rally, but I do have real definitive fear at this point to the downside. The FOMC meeting, yeah, it's going to happen. Does it really matter? It's going to happen. I think it's all priced into this marketplace at this point in time. Now, the FOMC, if they were to soften up their stance a little bit, that there's some, recessionary fears, that could change the way we feel about markets. But quite frankly, with inflation raging, just absolutely raging out there, I don't think they have much of a choice. I think they actually got their hand twisted behind their back at this point in time. And again, if you take a look at the SPX, okay, one of the critical aspects of the SPX this week is that there are literally, okay, trillions of dollars riding on this expiration. Trillions of dollars riding. And normally it's in many billions, hundreds of billions of dollars. We're actually going to be in the trillions this time around for an expiration. It's actually one of the largest expirations when you start looking at the SPX, the spiders, the S&Ps, and the S&P options on futures. Okay, some of the largest positions ever are going to be coming off late in the week. So there's going to be heavy positioning, lots of gamma risk in here. What I want you to understand is exactly where the upper and lower edge of these expected moves happen to be. To the upside, we have 40.32 to the upside. Now these are specific to the SPX. Okay, so we're 40.32 to the upside. To the downside, trading to the downside. Let's get our mouse on it. Okay, you're 37 less, roughly 37.70. Okay, so to the downside, we have 37.70. Obviously, this would be cracking into new lows for the year. Okay, what do I anticipate? A lot of pressure coming into the marketplace. Every bid to the market. That basically means, for those of you that are not trader geek or don't speak trader geek speak, every bid to this marketplace I feel is going to be hit to the downside this week. You're going to see some attempts for some bid backs, some short covering. Clearly, there's going to be short covering. Possibly even on Sunday night, there's going to be some short covering. You got to have fear, okay, in you. If the VIX is not scaring you because it's so low, all right, let me scare you. The fear is simply this. Volatility has yet to explode, okay? We're right on and cresting into recent lows. So it makes a lot of sense for this point in time for us to come off just a little bit further. And all of a sudden, volatility catches fire. If volatility catches fire, it's actually going to cause the market making firms to sell into the selling. As I just said, there'll be some short covering along the way, but this coming week, this is going to be a rough one and possibly a complete repricing of the S&Ps to the downside. Last but definitely not least, as we do every week, obviously we talked about the expected move. It's $131. We just went over those levels. Here's a really cautionary tale coming into this week. Yeah, the FOMC, as I said, push it aside. Stop listening to all the garbage out there. This is where we have to be a little bit concerned in this coming week that major firms are going to come out and they're going to start to warn, right? Stuff like Apple. I know its earnings are coming up July 26th. I can see that. But many of the financials, we're only a few weeks away from some of the financial stocks starting to release earnings, okay? A few weeks away, just about a month, maybe 5 weeks out before we start hearing earnings again from the likes of Bank of America, which means if they're going to warn, all right, of missing, like Target did throughout the course of the week. There's actually several firms that came out, but Target again, I think was one of the big shockers as they missed. They're actually guiding a little lower there. Again, many companies that are guiding lower. There's going to be lower guidance. It's coming this next week, maybe the week after, but most likely this coming week if there's going to be guidance. Now, there's no timing that. You're just going to come out before the open and be like, surprise, we're lowering our guidance for the quarter and for the rest of the year. I think we have to be really concerned about this. There are going to be exogenous shocks to the marketplace throughout the course of the week. The FOMC is the easiest thing. right? One of the hardest things is you're going to see a bigger inversion of the yield curve, citing recession, stagflation, again, rising rates. But those rates are going to be rising in the shorter duration paper. That's it for this week's update. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.